Hello there. Welcome to Principles of Accounts O level. We've got a question that we want to look at from the past exam paper from 2018. The question is on partnership, and the question reads on part 3A, the partnership business of Philly and Panache runs two departments, furniture and grocery. The following balances were extracted from their books on 30 June 2016 after the preparation of the departmental trading account. So we are given the balance that we are given there, starting from gross profit, and the department that we have are furniture and grocery, and we have got gross profit for grocery and furniture, and other balances that we are given in the question down to the last balance. Then we have got additional information where we are going to have depreciation, allocation, or how we are going to calculate depreciation on the machinery and motor vehicles, and other additional information. Then we go to the first part of the question. If you go to the first part of the question here, the question part A is saying prepare the partnership combined profit and loss account and an appropriation account for the year ended 30 June 2016. So we are going to see that the trading account is already prepared. So we are going to start on gross profit for the profit and loss for the profit and loss account. So we go back to check the figures for gross profit, what we have there. If you go there at the beginning of those balances, we've got figures for gross profit that we have there. If you come here now, these are the figures for gross profit. We've got 102,000 and 78,000. So those are the two figures that we are going to use. Remember, it's a combined, so we are going to add the gross profit for furniture, 102,000, then we get to add for gross profit for grocery, 78,000. So we go back again to our answer section and add those two figures. So here we have we are going to add those two totals to get the total for gross profit. We have got 102,000, and then we add 78,000. 102,000 plus 78,000. After adding the two, the total that you are supposed to get there is 180,000. Right. So from gross profit, we go to less operating expenses. So here is less operating expenses. So on the operating expenses, we're going to list them just beneath this heading of operating expenses. So we go to the question to check what operating expenses do we have. And remember, operating expenses are the expenses that we incur in the day-to-day running of the business. So those are the typical expenses that we are going to look at. So if you come from the top there, the figures are starting from gross profit. You go down checking what operating expenses are we having there, right? If you come here, we have got our fixed assets or non-current assets that we have here with machinery, and also with motor vehicles, and also there's an issue of depreciation. Remember, depreciation is a non-cash item, but we charge it in the profit and loss account under operating expenses. So we want to see what method of depreciation are we going to calculate using machinery. Let's look at the machinery first, and then we go to additional information to look for that information on how to calculate depreciation on motor vehicles. So if you go down here, you'd see that depreciation is mentioned here, and machinery is being said machinery 20% per annum on cost. So basically what it means is we are just going to say 0.2. Remember the formula for straight line method was this one, which is per annum or the cost, means this is straight line method. And the formula that we use for straight line, we say percentage times net, percentage times costs. We say percentage times costs here. That's the straight line method. So we are just going to say 20%, then we apply the cost of machinery. So if you go up there, we are going to check the figure for cost for machinery. We come here, we've got 80,000 here for machinery. So we are going to say 20% of 80,000. So if you recheck there, the percentage that we have there for that calculation is 20%. So 0.2 times 80,000 is what we are going to calculate there. So we are going to start with depreciation. So we can just say depreciation depreciation here. Then our depreciation, we have what machinery. So machinery is the one that we are calculating first. And we are saying we can calculate it using 0.2, which is 20%. Then we multiply by 80,000. Multiply by 80,000. So if you say that if you multiply 0.2 times 80,000, you are supposed to get 60,000. So we put in this formula, in this column, then 16,000. Then the next one that we have in the question is motor vehicles. So the next one here is motor vehicles. So we want to see again what method is being used to calculate depreciation for motor vehicles. It's mentioned again there in the additional information. So for motor vehicles, it's here. It's saying motor vehicles 20% per annum using the reducing balance method. So using the reducing balance method, now it becomes a different scenario in terms of the formula. We are now going to say percentage times net book value. And at the net book value, we use the balances at the beginning of the year of the cost and accumulated depreciation. Net book value now, we'll find it by saying costs of the non-current asset minus the accumulated depreciation of the non-current asset. Accumulated depreciation, we know, is depreciation of that non-current asset from the day it was bought in the business up to the date we are calculating. So basically, it's depreciation up to date. So we check there in terms of that information that we have in the question. If you go up there, we've got balances that we are given in terms of we've got balances that we are given in terms of the costs and the accumulated depreciation of that motor vehicle. Right. If you come there, we have what the motor vehicle is here, and we are seeing that the cost is 120,000 and the accumulated depreciation is 72,000. So basically, what we are going to do there, we are going to say the percentage. If you check the percentage, and then we say we first calculate the net book value by saying 120,000 minus 72,000. The answer that we get, then you multiply by the rate that we are given. So if you go down to recheck the rate that we are given there, we are given it as 25%. So we are going to say 25%. We multiply the answer that we get for 120 minus 72. So we go back to our answer section. Then we do that. We say 25%. Here we are saying 0.25, and then we multiply by 120,000, and then let's check the actual figures that we have there. 120 minus 72. 120 minus 72, and the rate is 25%. So here we are saying 120 minus 72, 72,000. Right. If you calculate that one, so this one, we also put it in brackets, the calculation. Also put it in brackets here. So if say 0.5 times the answer that we get for 120,000 minus 72,000, we are supposed to get 12,000. So here we have 12,000. So then from there again, we are going to check other operating expenses that we have in the question. So if you go back again in the question there, if you go back in the question again, we are going to see that we have from depreciation, we are here. We go to trade receivables. Trade receivables is not an expense. Remember, it's a current asset. These are debtors. Trade receivables are also debtors. Then we go to wages and salaries of staff. This one, we put it under operating expenses. Remember, we also have salary here down there, but this salary is for a partner. Salary for a partner, we put it in the appropriation account, but salary for staff, we put it in the operating expenses section. So we have 49,100 that we have here for wages and salaries of staff. And then before we enter that 49,100, we check whether we have got an adjustment regarding those salaries and wages. We are told here on two that salaries and wages owing to of staff amounted to 3,100. So what is key here is the word owing. So it means if it's owing, remember, if it's an expense that is owing, we add the figure that we are given in the list of balances. Because this is a figure for this period, but it's not yet paid. So we need to add it for us to comply with the matching principle or the matching concept, or we rather call it again the accruals concept. So that's the issue there of adjusting for accruals or balance owing. We add, and the opposite is true for prepayments or those that are paid in advance. We subtract them because they don't belong to this period. That's we are now abiding by the matching concept. So that's our salaries and wages of 3,100. We are going to add it to the figure for salaries and wages that we are given there, which is 49,100. So we go there and we put that expense, which is wages and salaries. We have got wages and salaries. And the calculation there on wages and salaries, we say is 49,100. And then we add the balance that is owing, which is 3,100. So if you do that correctly, you are going to get 52,200. And then we go back again to check any expense that we can put then under. After salaries and wages, we got cash at bank. This is the current asset. Go now to general expenses, another operating expense that we have. So before we enter that again, we check on additional information if we have got any adjustment that is affecting general expenses. If you go to number 3, we have got general expenses included rates prepaid for 4,000. So what does it mean? It means inside the general expenses, we have got rates that are inside there, but these rates also do not belong to this period. They are prepaid, they are for the following period. So what do we need to do? We need to remove this 4,000 out of the figure that we have for general expenses. And when we remove that one, we don't put it anywhere because it's a prepayment. It doesn't belong to this period. What we can only adjust, we are going to adjust this in the statement of financial position or the balance sheet. We'll put this 4,000 under current asset as a prepayment. Remember, a prepayment of an expense goes under current assets. So we go up there to check the figure that we have, to recheck the figure that we have for general expenses, so that we add the 4,000. Sorry, we subtract that 4,000. General expenses, we have got 34,000. And then we subtract the 4,000. So we go back again. Here we are going to say general expenses. General expenses. So we are going to say 34,000 that we have in the list of balances. Then we subtract the prepayment, which is 4,000. So if you do that, obviously we get 10,000. Then we go back again to check another operating expense that we can have in the question. We are seeing there after general expenses, we've got premises. These are non-current asset drawings. They are not adjusted in the profit and loss. We have got salary. Remember this, we said we adjusted in the appropriation part. So we are finished with these adjustments on operating expenses. So it means we can now add them to get the total. Right, so we can now add that one to get the total. Right, if we come here, we can underline here so that we can get the total. If we add 16,000 plus 12,000, and then we add 52,200, then we add 30,000. The figure that we are supposed to get there is 110,200. Right. This figure is for operating expenses. So remember, operating expenses, we are saying less here. We are saying less. So we are saying now 180,000 minus 110,000. Then we subtract here. Right. So when we subtract that one, 180,000 minus 110,200, then we get 69,800. So here we are going to put 69,800. Right, so we go down. So it means we have finished the first part there. That 69,800, we are going to call it the net trading profit. This is the net trading profit. So this is the net profit that we know. Net trading profit. So in the case that maybe we had a negative figure here, in the case that maybe this total of operating expenses is greater than the figure that we have there for gross profit, it's going to be a loss. So we are going to call it a net trading loss. So that's what we have. So under that now, we now add interest on drawings. We now add interest on drawings. So on interest on drawings here, we can just say add. We are now on the appropriation part now. We add interest on drawings. So for interest on drawings, we are going to check the partners that we have there and how we are going to calculate the interest on drawings. We check on additional information in terms of how we calculate the interest on drawings. Right, so interest on drawings is on this point, saying interest on drawings is charged at the rate of 2% per annum. So we're going to say 2% of the figure that the balance that we are given for drawings for those partners. So 2% as a decimal, as we know, is 0.02. So we're just going to say 0.02 times the figure that we have for drawings there. So if you come here, we've got for Phil is 30,000, so it's 0.02 times 30,000. Then for Panache, 0.02 times 50,000. So we go back there. So you've got 30 and 50. 30 and 50. Right. That's what we have here. So if you come here now, we say interest on drawings. We've got two partners that we have. We've got Philly. We have got Philly here. So we are going to say 0.02 times 30,000. Then if you multiply that correctly, you're going to get 600. Then we have the other partner that we have is Panache. So Panache is 0.02 times 50. And if you do that correctly, you're supposed to get 1,000. Right. So that's what we have in terms of the drawings there. And then we add now the two. Remember, in appropriation, first we add the interest and drawings, then we subtract the other part. So if you add the two, you're going to get 1,600. And remember, we are saying add. So we're going to add this figure to the figure for net trading profit. So we are just going to say 69,800 plus 1,600, then we get 71,400. Right. So beneath that now, we are now subtracting interest on capital, and then we also subtract the salary for the partner that you are given. So here now we are saying less interest on capital. Interest on capital. So for interest on capital, again, we go back to check how we are calculating this interest on capital. If you come here again on additional information, there's something that is mentioned in terms of calculation of that interest on capital. Right. If you come here, we are saying interest on capital was allowed at a rate of 10% per annum. Capital accounts to remain fixed. So what is important is this rate, which is 10%, and this is a decimal 10% is 0.10 or 0.1. So we go back to check the balances for capital that we have. Balances for capital that we have here, we have got Philly 250,000 in Panache 300,000. So we are going to come here now and say for interest and capital we have Philly. So in brackets we show the calculation. Remember 10% we say 0.10. Then we multiply by the figure for Philly, which is 250,000. So if you calculate that correctly, you're going to get 25,000. So we now go to the next one. Right. On the next one, we also have Panache. So for Panache, we're also saying 0.10, and then we multiply by 300,000. And if you do that, you get 30,000. Then that's it on the interest on capital. And then remember, we also have to subtract salary, so you can just say partners salary. And you go to check, usually in most questions we've got one partner that is allocated a salary. So we check there what we have in this question. Right, for salary, we are given Panache is the only one who is receiving a salary of 10,000. So we go there and write Panache 10,000. Right, so here salary we put Panache, and then it's 10,000. Sorry, it's 12,000. 12,000. Right, so having this, we can recheck to check the figure for salary there. Sorry, it's 10. We've got 10,000 for salary there that we have 10,000. Figure is 10,000. Right. So those are the figures that we have. So we need now to add 25,000 plus 30,000 plus 10,000. So if you do that correctly, what do we have there? 25 plus 30 plus 10. Let's try to calculate that one. We get here is 5, then here 5, 6. So you're going to get 60,000. So here you can underline 65,000. So here we can put our 65,000. And remember, this figure we are saying less here on this part. So we are subtracting this 65,000 from 71,400. So when you subtract, you are going to get, let's try to calculate that one, 71,400. 71,400. Then we subtract 65,000. We're able to get 6,000, 6,400. So here we get 6,400. Then we underline here to show that this is the profit that we need to share. So the profit, the figure that we got there is the profit that needs to be shared between the among the partners that are there. So beneath that now we share this profit. Remember, in a partnership, the profits are then shared according to the profit sharing ratio that is given in the question. So here we are going to say share of profit. Share of profits, and what Philly. We have Philly, and then we check the profit sharing ratio that we have in the question. Let's try to go down, check what profit sharing ratio we have in the question. So this profit sharing ratio that is there is 5:6. So it means the denominator is going to be 5 plus 6, which is equal to 11. So for Philly, here we are going to say 5/11. Then for Panache is 6/11. Then you multiply with the figure that we got 6,400 for both of them. So we go there. Then for Philly, remember we are saying it's 5/11, so we get 5/11. Then you multiply by the figure of 6,400 over 1. What do we get there? Let's try to calculate that one. We are saying 5/11. Then we multiply by 6,400. We get 2,909. 2,909. It has got 0.09. So this is the figure that we are getting. So if you round it off, it means 2,909. So here to the whole number, it becomes 2,909. And then the other one is Panache. So for panache, it's 6/11 times 6,400 over 1. Then you calculate again that one, 6/11. Then we multiply by 6,400. So again, this one is 3,490.9. So the whole number becomes 3,491. 3,491. So we're just rounding off to the nearest whole number. So if you add the two, if you say now 2,909 plus 3,491, you are supposed to get 6,400. So the figure that you get here should be the same with this one. So that is what we have in this partnership account in terms of the profit and loss and then the appropriation. So we check again, we've got a question that we have beneath that. Let's, for next question, let's check the next question that we have. Right, on 3B, it's saying complete the information, complete the following information table. We have got some transactions that we are given and we are being asked to detect which type of accounting concept we have. Remember, we've got different types of accounting concept that we have to abide by as we prepare our records in terms of the financial statements and the ledgers. Let's look at the first one. It's saying calculating depreciation using the same method each year. So we are being asked to see which accounting concept are we abiding by this calculation of depreciation using the same method of each year. So this one is consistency principle. The consistent principle requires us to adopt a certain principle or concept and be consistent with it from one year to the other, rather than changing from one period to the other. It lacks consistency. For example, using the straight line method to calculate depreciation for a certain fixed asset this year, next year you change to reducing balance. There's no consistency in that, and it will compromise comparisons of the financial statements from one period to the other because you'll be using different methods. So the most appropriate here is consistency. So this is the consistency principle, or you can call it consistency concept. Then you go to the next one saying recording non-current assets and costs. This is the historical cost concept, and it says that non-current assets should be recorded at their cost, original cost value. And this is done to prevent overvaluation of non-current assets. Because if you value them at current market prices, that is what are we getting if we sell it today. When we record them on those values, we are overvaluing them. So we should record them at their historical costs. So this is the historical cost concept. The historical costs concept. Right. So the next one is saying recording revenue ends during an accounting period whether cash was received or not. Right. This is the accruals concept. We can also call it the matching concept. That is, we should match the expenses for this period with the revenue end for this period. So basically, what it says is what belongs to this year should be recorded this year, and what belongs to next year should be recorded next year. That's why we adjust for those accruals and prepayments, whereby we add accruals. We are saying this expense was not paid, so it's an accrual, but it belongs this year, so we should add it. And for prepayment, we are saying it's an expense for next year which was paid this year, so we should subtract it because it doesn't belong this year. So that's the matching principle. So this one we have the matching, and this one is the historical cost. This one is consistent. Then we go to the recording non-cash expenses so as not to overstate profits. Remember, whenever we are trying to avoid overstating profits, we are abiding by the prudence concept. We are abiding by prudence concept, whereby we are saying we should give a provision to any expenses that we might incur in the period. So this one, the most appropriate is prudence. prudence concept. Then we move on to the next one. Saying recording a business transaction twice. This is a very simple one, the most basic one, which is the double entry concept. And it says that every debit entry has got a corresponding credit entry. So the dual aspect is being employed there, whereby when we debit, we also credit. We should make a corresponding entry. That's the double entry concept. So here we have the double entry concept. So that is what we have on that question. Let's try to look if we have another question for we have the last one, which is saying for each of the following transactions, set the source document. Remember, source documents are the documents that we expect you to be given in the accounting process. So on source document, that's where the accounting process starts. When you go to buy something, what document are you given? That's when accounting process will be starting. So the first one is saying sold an old machine for 3,000 credit for D. Danilo. So what we know is when we are selling, it's either we are going to receive cash or we are going to sell on credit. So when we receive cash, we receive a. So when we sell on a cash basis, we are going to issue a receipt. But if we are selling on credit now, there should be an invoice. So an invoice, the source document that we are looking for there. Invoice. But remember, this is not a sales invoice because we are not selling goods. We are selling a non-current asset or a fixed asset. So this one is just a general invoice. An invoice, but it is a general invoice, not a sales invoice. A sales invoice only applies to the goods that we sell. And then we go again to check what we have. The next one is saying a check for 10,000 received from T Trust. A data was returned by the bank marked repair to drawer as RD. Right. This is a dishonored check. It's a check that indicates that when it was at the bank, it wasn't processed due to certain reasons, e.g., insufficient funds. So, what source document can we see that is something like that has happened? We can always see that on the bank statement. So the bank statement becomes the source document. So here we've got here we've got the bank. We have got the bank statement. Bank statement. A bank statement is a document, external document that we are given by the bank, and which reflects our cash and bank transactions that pass through the bank. So on that bank statement, that's when we can see that there was a dishonored check. So that marks the end of our question paper, guys. Those who haven't subscribed, please subscribe as we keep in touch towards our exams. With that, I'm out.